normal way a correction transpires, right? You have a bottom and then you have a rally, and then you generally, not always, retest the bottom, and I think that's exactly what we're doing here. So that by itself doesn't really tell me anything, right? The question is what happens going forward. Do we break down? Do we go to a new high? Do we have a trading range? So let me kind of tell you how I'm thinking about what's important. Why the market is correcting is really not that important to me, because if the market wants to correct, it'll find a reason. There's always something happening in the world that you can point to as some kind of an impending catastrophe, right? And the market can correct. So the way I look at it is there's three sort of the nature of the correction is important to me. So there's three possibilities. The worst case is this is the top of the market and we've begun a topping process. So obviously, number two, we're in the we have mid-cycle elections, right? Generally speaking, this is the corrections in midterm elections tend to be much more pronounced than in the rest of than in non-election years. And this is my assumption that that's what we're going to go through. Statistically, you don't really get a good rally until the elections are over. So we'll be waiting. And so that's kind of my assumption that that's where we are. And we're going to be through a trading range until we have the election, and then you can have a rally. The best case scenario would be that all this is a reset. So what happened last year, of course, we had almost zero volatility. Market kept going up almost every day. Perhaps the market got over exuberant. There were good reasons last year why the market was running, right? You had the economy was doing great globally. The tax changes were coming, etc. But perhaps the market got over enthusiastic, and now we're going to reset the expectations a little bit and the multiples a little bit so we can go higher. That would be obviously the best case scenario. So I'm taking the middle ground and I'm saying the way I'm acting is I'm assuming that this is going to be a difficult year, sort of almost the opposite of last year, right? Last year we had no volatility, lots of traction on the way up, and perhaps this year will be the opposite, and we'll have lots of volatility, but really the market won't go anywhere except round and round and round. I think all of those are serious issues, and I think the investors don't really. We are late in the cycle. There's no question. This has been one of the longest cycles already. At some point, the investors would expect some kind of you would expect that the economy is going to be in a recession. Whether it's mild or not mild, we can debate that, right? And every time you get a correction, such as we've had, people start thinking about the possibility that this is the beginning of the end. You have U.S. raising rates. Now this morning, even Europe said that they perhaps should be looking at some kind of a tightening. Well, I don't know how long it's going to take them. Europeans take forever to make a decision, but even they talking about it. The only reason UK hasn't tightened is because they're negotiating a Brexit. Otherwise, I think they would have tightened. They would have raised rates. So you're in an environment that is ripe for end of the cycle kind of corrections, right? Like you are ripe for for the market to be topping. The only reason I'm not convinced that that's where we are now is because of the tax changes that in the U.S., which almost guarantee double-digit earnings growth for this year, which the market may or may not react to. We will see. But I also the other thing I would point to is that there's the repatriation of cash repatriation, and that has been talked about a little bit, but not enough perhaps. And that cash, if you kind of listen to the guidance, a lot of it, they said 40% on average is going to be spent on capital projects. Well, that should perhaps lengthen the recovery by another year or two. And that they will make either acquisitions or they will spend it on some kind of a capital project. They also said they will obviously give bonuses to the employees. That's kind of 20%. And so the guidance was very clear of how much of the spending goes where. All of the spending should be accretive in terms of growth, right? Because even if it goes to the employees, they can spend it. So that also could stimulate the economy, but not necessarily as much, because the employees, if they get bonuses, could save them. So that's not as clear-cut cycle extender as the capital spending. They already said that we will spend 40% of the found money on capital projects. That's a gimme. So that will happen. And by definition, that does extend the cycles.